The trend of the market can be as easy assessed by seeing what the trend is doing or what the trend is not doing. As we can see in today's trading or these past couple weeks, there's really no direction. We're also seeing down days followed by up days followed by down days. That gives you an instant visual realization that there's no consensus between the bulls and the bears. So having the visual ability to quickly analyze what each of the major indexes are doing allows the candlestick investor to make a quick assumption of which way the overall market is going. As we saw, the Dow is going sideways. Same scenario on the S&P. The NASDAQ is drifting, but the transportation index still has a upward bias. So that assumption, based upon all those indexes, is there some sectors are selling off while other sectors are acting strong. This doesn't reflect the overall investor sentiment is bailing out. It's just telling you that there are now some sectors that are having profit taking while other sectors are acting well. Knowing which patterns are the best patterns to be trading has two benefits. One, it tells you which way the price is moving, not only moving, but has a high probability of high profits. And two, they will still act well even when the market is trading against you. We recommended SIG, Signet Jewelers, because of a very simple bobble pattern. Bobble patterns created by when it hits the first resistance level, we can see there's a bearish engulfing signal. It's time to take profits. Then we have that little bobble that comes back up through the resistance level that if you took the 50-day moving average out of here as an added indicator, it simply is showing you you've got a J-hook pattern in progress. Also, a lot of people ask, why don't you use relative strength indicator versus stochastics? Because the relative strength indicator is kind of a duplicate piece of information. We could see what happened in SIG today. It was trading positive on a day when the Dow was down 155 points. That immediately tells you the relative strength of this move is much better than what's going on in the market. The investor sentiment that builds up a pattern, like our recommendation a while ago on NVGS, we're still holding, because notice what you have, a big fry pan bottom, which is created based upon investor sentiment disregarding what the overall market trend is doing. The pattern itself is telling you there's decisions being made over the past that's creating this pattern. So even on a big down day, a pattern is still going to work fairly effectively, at least putting you in situations where if your portfolio has X number of long positions, that if you're trading patterns, the majority of those long positions will still act well even when the market is trading off. That'll be it. We'll see you in the chat rooms.